Video on variances reconciliation statements. I'm going to reconcile variances by flexing the budget. So I've got an example here for you. Got Rupro Limited manufactures one product, RP007, and the company operates a standard costing system. The managing director asks you, the management accountant, to explain why the actual profit in May of £46,500 differs from the budgeted profit of £35,000. Now here's the information we're given. So we've got budget for May and then the actual for May. So sales and production, the budget was 5,000 units at £75 each. So we expected to produce 5,000 units at a cost of £75 each. But the actual for May was 6,000 units at £70 each. The materials now, the budget for May was 5 metres per unit at £4 per metre. And the actual for May was 5.5 metres per unit at £3.50 per metre. Now the labour, 2 hours 30 minutes per unit at £12 per hour was a budget, and actual was 2 hours per unit at £14 per hour. The overheads were 90,000 for May budgeted, and the actual were also 90,000 for May. The profit for the month for budget for May, the budgeted amount was 35,000. The actual amount was 46,500. Now this is what we've got to do. To provide the managing director with an explanation, you decide to calculate the following: the sales volume and sales price variances, the material price and usage variances, the labour rate and efficiency variances. And part B, prepare a reconciliation statement which shows how the variances have caused profit to alter. So how have they caused the profit to change? Right, solution now. So the sales volume variance is the first one. Now to do the sales volume variance, you've got the standard quantity of sales times the standard selling price. So the standard quantity of sales, we go back to the question, let's go to the budget amount, was 5,000 units. And the standard selling price was £75. So it's going to be 5,000 times £75. The actual quantity of sales, I go back, was 6,000 units times the standard selling price. And again, that was our £75 here. So we do the calculations. 5,000 times 75 gives us £375,000. 6,000 times 75 gives us £450,000. So that gives us a difference of £75,000. So the actual quantity of sales was greater than the standard quantity of sales, therefore it's favourable. Now the sales price variance is the actual quantity of sales times the actual selling price. So back to the question information, actual quantity of sales was 6,000 units at £70. So that's 6,000 times £70. Then the actual quantity of sales times the standard selling price. So the actual quantity was 6,000 and the standard selling price, back to the question, was £75. We do the calculations now. 6,000 times 70 gives us £420,000, and 6,000 times 75 gives us £450,000. So the difference there is £420,000, take away £450,000, it's £30 and £30,000 difference, and the actual selling price was less than the standard selling price, so therefore it's adverse. So it's £30,000 adverse. So the standard selling price, the actual selling price was less than the standard selling price, so at £30,000 adverse. Material price variance now. So it's the standard cost times the actual quantity of material used. So with the standard cost, so back to the information, it's £4 per unit. The actual quantity of material is going to be 6,000 units, and the amount per unit, if we just go back to the information, was 5.5 metres. So it's going to be £4 times 6,000 times 5.5 metres. That comes to £132,000. Now the actual cost, we go back to the information, the actual cost was £3.50 per metre. So £3.50, the actual quantity was 6,000, and the amount of material used was 5.5 metres. So just check that one up here. So it's 6,000 and 5.5 metres. And so £3.50 times 6,000 times 5.5 comes to 115,500. And we've already said £4 times 6,000 times 5.5 comes to £132,000. And the difference here is £16,500. So the actual cost is less than the standard cost, so that variance is favourable. Right, material usage variance now. So standard quantity of material for the actual production. So the standard quantity of material, we go back to the question, is 5 metres. and the actual quantity is 6,000. And then the standard price, just check that in the information. So standard price was £4. Then we take away the actual quantity of material used times the standard price. The actual quantity was 5.5 meters, which is in the information question, times 6,000 units. And then times the standard price, and then the standard price was £4 per unit. Sorry, £4 per metre. So we do the calculations now. 5 times 6,000 times 4 gives us £120,000. And 5.5 times 6,000 times 4 gives us £132,000. So the actual quantity of material used was greater than the standard quantity. So we've got an adverse variance of £12,000. Right, labour rate variance. So it's the standard cost of labour times the actual labour hours. So the standard cost, so back to the question, is £12 per hour. And the actual hours were 6,000 units times 2 hours per unit. So times 6,000 times 2 hours per unit. And the 12 times 6,000 2 hours gives us £144,000. Now we've got to take away the actual cost times the actual labour hours. So the actual cost, go back to the information in the question, is £14. And the actual hours was 6,000 times 2. That gives us 14 times 6,000 times 2, gives us £168,000. Now the difference there is £24,000. And then the actual cost is greater than the standard cost, so it's an adverse variance. Now the last variance is the labour efficiency variance. So it's the standard labour hours for production. So the standard labour hours were 2 hours 30 minutes, that's 2.5, and the production was 6,000. So we've got 2.5 times 6,000. And then the standard rate, we just checked that once a moment ago, standard rate for labour was £12 per hour. We're going to take away the actual hours times the standard rate. So the actual hours, we just check that in the information in the question, is 2 hours. And 6,000 units, and then the standard rate was £12. So 2.5 times 6,000 times 12 is £180,000, and 2 times 6,000 times 12 is £144,000. So the difference there is £36,000. So the actual labour hours is less than the standard labour hours, so the actual variance is going to be favourable. Right, now we're going to use all of these variances into our reconciliation now. So the highlighted bits, the yellows, that's the variances we've already calculated already. So I'll get back to them in a minute. So we've got the original budget of 5,000 units, a flex budget of 6,000 units, and then the actual cost for the 6,000, revenue and cost for the 6,000, and then the variances. So we're going to the bit below. Sales. The original budget was 5,000 units at £75, so it's £375,000. So that's our £375,000 here. Now the flex budget is 6,000 units. So at 6,000 times £75, that gives us £450,000. And the actual was 6,000 units at £70, which gives us £420,000. That's our actual sales, £420,000. Now you'll see there that the variance then is the 450,000, take away the 420,000, that gives us a variance there of £30,000 adverse. Now we'll come back to that in a moment. Right, materials now. So the materials for the original budget, 5,000 units. So materials. Original budget is 5,000 units times 5 metres times £4 per metre. So it's going to give us £100,000. I'm going to flex it for 6,000 units now. So it's 6,000 times 5 times 4. That gives us £120,000. Then the actual was 6,000 units times 5.5 metres times £3.50. That gives us 115,500. So 115,500. Now labour now. So just taking the materials there, and you can see the variance there is 120,000, take away 115,500, gives us 4,500 favourable. Right, labour next. So the original budget was 5,000 units times 2.5 hours at a rate of £12. It gives us £150,000. So in labour, the original one was £150,000. Now we'll figure for flexing a budget for 6,000 units. So 6,000 units times 2.5 hours times £12 per hour, which gives us £180,000. Now the actual was 6,000 units, 2 hours per unit at £14 per hour, which is £168,000. So you can see there the variance is 180,000, take away 168,000, gives us 12,000 favourable. Now the contribution is going to be your sales, less your materials, less your labour. So that's 5,000 units. For your 6,000 units flex budget, it's going to be your 450,000. Take away 120,000. Take away 180,000. That's £150,000. And for the actual 6,000 units, it's the £420,000. Take away the 115,500. Take away the 168,000, which gives us 136,500. So the variance there is 150,000, take away 136,500, gives us 13,500. Now the overheads, we're going to check that in the question. The overheads, all the way back to the question, I think they were £90,000 per month. That's it. They were £90,000 budget, and also the actual was 90,000. So let's put them in now. So my overheads is 90,000. So there's no variance there because the budget flex was 90,000, the actual was 90,000. Profit for the month is going to be your contribution. Take away your £90,000 there. And then the same for the 6,000 units, 150,000 take away 90,000, giving us 60,000. And the actual 136,500 take away 90,000 gives us 46,500. Now we check these two figures in the question now. The budgeted profit a month we had there was 35,000. So back to the question. There you go. The budgeted for May was 35,000. The actual 46,500, which should be the figure in our table below. That's it there. Now the variance is the 60,000. Take away the 46,500, which is 13,500 adverse, because the profit is less than expected. Now you see all these yellow ones now. These are the variances we worked at earlier on. So for the volume for sales was 75,000 favourable. Was that figure there? And the sales price variance was 30,000 adverse. So that's there. So the volume has changed there. Volume favourable by 75,000. And the price has gone 30,000 adverse. Now, the materials one, where the price is 16,500 favourable. So I just made a note of that. Price 16,500 favourable. And material usage was 12,000 adverse. So that's 12,000 adverse there. Now you'll notice here that the 4,500 favourable there is a combination of the price variance and the usage variance of material. So 16,500 favourable and 12,000 adverse gives a net of 4,500 favourable. Likewise in the labour one now. The labour rate variance was 24,000 adverse. So there you go, labour rate 24,000 adverse, and labour efficiency was 36,000 favourable. So that's the 36,000 favourable there. Combine them both together, 36,000 favourable and 24,000 adverse gives us the 12,000 favourable there. Now, so our contribution is 13,500 adverse, so it's 30,000 less the 4,500 less the 12,500. Because the sales were 30,000 adverse, materials were 4,500 favourable, and labour was 12,000 favourable, giving us a net difference of 13,500 adverse. The overheads, there was no variance there, which gives us the profit per month of 13,500 adverse. So that's the reconciliation of variances by flexing the budget. So thank you for watching.